Okay guys, this video is quite a quick video. What we're going to be covering are the spreads in the market and essentially the raw spread account versus a standard account. Now spreads move in 3 cycles. They do move in 4, but for argument's sake we're going to say 3. So what we have is 9:55 pre-market close. Spreads will start to expand because of low liquidity. Then 5 minutes after 10 is when brokers reopen. You're actually allowed to trade. Spreads will open and they'll be quite large. On a standard account, you will see huge spreads depending on the currency you're trading. If it's not a major pair and it's exotic, it will be crazy. We also have the 10:30, which is essentially like pre-market for Asia. Spreads will, as soon as it hits half past, spreads will dip like 0.1, 0.2 pips. They'll drop down. And then as soon as we hit 11 o'clock, which is Sydney, Australia time, you will see the spreads drastically drop. But it's obviously the cost and the spread for a raw compared to a standard account, which you will see me comparing. Okay, so on the left hand side we have a raw account, and on the right hand side we have a standard account. So as you can see, the spreads are slightly different. I've selected the major currencies, so it's this euro dollar, pound dollar, dollar yen, dollar Swiss franc, dollar CAD, Aussie dollar, New Zealand dollar for this test. Okay guys, so on the left hand side we obviously have the raw account. On the right hand side we have the standard accounts. So these accounts are exactly the same. They are both demo accounts, they're both 100k, and we will be placing a one lot buy on both of these accounts. The spread is slightly bigger due to the fact that it's 5 minutes before the market close, which means it's low liquidity, so less money is being pumped into the market, less people are trading. So basically the broker's just trying to cover their asses and just increase the spread slightly. So here we have one lot which has been placed for a buy. As you can see on the left, we have a £5.21 total fee. In charges we have £4.50 and spread cost is 0.71p, so 71p. On the right hand side we have £8.45 total and no charges. So already these are taking the exact same time, exact same price, and we can see that we're getting about a 38% increase just off the fact that we're using a standard account, even though we're placing the same lot sizes, same account, same leverage, everything. So so yeah, we've placed that. I've closed the trades, and now we're just comparing the total fees, the total costs. I was quite interested in this actually because I didn't realize that the standard account would actually come out to more of a cost, but as you can see, it has. Okay, so we are approaching 10:05. The markets have already opened at 10, but brokers will not allow you to execute any trades until 10:05, maybe 10:07, depending on your broker. As you can see, the spreads for the raw account are much lower than the ones for the standard account. The standard account we're seeing like 3 pips, 6 pips, 7 pips, 8 pips, whereas on the left we're seeing pretty much sub 5. So this is the worst time to trade. You do not want to put yourself in this position. The markets, the spread is expanding and contracting. There's no liquidity in the market. So you're basically trading at the most vulnerable position you could be trading at. If you just wait another hour, the markets and the spread will always return to the same price, literally 99% of the time. So you do not need to stress, you do not need to place a trade, because you'll just be costing yourself more money, and you'll be putting yourself at a disadvantage. So the market will move in 3 cycles, which I'm going to cover. The first cycle is 10:05. That's the initial phase of when the market spreads will slowly start to contract. Okay, so we're approaching 10:30. The time is 29 past 10. So we have about less than a minute to go, 30 seconds. So what happens here, the market will drop in spread. The spread will drop about 0.2 pips, 0.1 pip. It's called a pipette, whatever you want to call it. But let's just keep it simple. So it's 0.1. So we've just hit half past. You've just seen a big fluctuation on the left hand side. Everything's dropped by about 1 or 2 pips. And on the right hand side, we're still seeing it sort of as it is, as usual. I'm just going to give you a visual representation here so you can actually see the spreads on a 1 minute time frame as well, just for your sake. Okay, so we are about to hit 11 o'clock, which will be the open of the Asian session in Sydney, Australia. Once we hit 11, please keep an eye on all the spreads on the left. Watch a big flash with all the currencies. You'll see one flash and all the pips suddenly start lowering. That's because liquidity is being put into the markets and more people are transacting. So that means that the market's now thicker. It's not as thin as it was before. So the spread can actually be reduced. So I'm giving you a visual representation here. You can see the spread is basically almost 0 pips, zero point 0.1 pip, whereas on the right we're looking at like 1.5 pips, and you can see the fluctuations with the standard account in comparison to the raw account. Now, guys, you might be asking yourselves, what's the account? What should I use? Look, if you're trading day in, day out, every day, 100% raw account. Always go over raw account. I just feel like the spreads are tighter, the costs are lower, and it's just more efficient to trade that way. Um, it's up to you guys how you want to do it. But from my past experience, I've never had problems with raw accounts. They've always been good, and I've always found them to be the best.
Ready for a drift? Tokyo drift.